Hello, this is the Theo Night Report for Thursday, July 7th. My name is Doc Severson. Okay, so after kind of a do-nothing holiday week, that's going to come roaring back tomorrow as we have our employment situation set for tomorrow morning. So go back to the early part of June. We had our first report back there. We were expecting about $1.80 and we got 38,000. It was a huge miss. But what it did was it put the Fed out of play, at least until late July. Okay, and then of course when the British referendum came along a couple of weeks ago, that really knocked things out of the park, right? So you got to remember, back in the May timeframe, the Fed was drumming up support for raising rates, perhaps in June, maybe late July. And of course that got completely taken out of the picture based on this report. Okay, so that was a huge thing that happened. So tomorrow morning we get to see whether or not we're going to hit anywhere close to 180. And this is where, we can't exactly predict what's going to happen with these things, but if we're sitting here at a 180, a Goldilocks number that comes along right around 180 basically puts the Fed out of play still for the next couple of reports. Anything less than that is actually market positive, because if we have another weak number, which is significantly below 180, I think the knee-jerk reaction will be to the downside, but then eventually I think the dip will be bought because of the fact that adds further certainty that the Fed will further stay out of the way of the market. Again, they're not going to be hiking rates anytime soon. Where we have to watch carefully for what the market does is if we put on a really strong number. Again, I think the knee-jerk reaction will be to the upside to say, hey, jobs are coming back, the economy's coming back. But then all of a sudden what happens is uncertainty rears its ugly head once again, because all of a sudden is the Fed back into play? Would they actually raise rates in July? Probably not going to be raising rates in September or anything close to the election. But certainly maybe that's on board for the December meeting as well too. So it should be really interesting. We usually get a fair amount of volatility and market reactions and kind of knee-jerk responses in the first half an hour after the release comes. Obviously, it's really the cash market that opens at 9:30 Eastern that's really going to dictate what the actual true market response will be. By then, the market's got an hour to parse through the announcement, to see what kind of revisions there were to the numbers, to see whether the participation rate continues to decline, whether the unemployment rate continues to go down. But again, that could be an artificial number based on participation. So there's a lot that's really boiled into this market right now. And this release, and a lot of this is already taking over as kind of the number one event risk in the market right now, because if the Fed's out of the way for the next several months because of what's happening in Europe, then we're going to have to watch this closely and the market will react to it. So going over to the charts here without spending a great deal of time on each one of these, as you're probably well aware, the price is kind of jammed up against all-time highs, and really this is where it's been the majority of the last year and a half, is right around this third rail of the 2100 level. It's been unable to mount any kind of assault above and beyond there with any kind of sustained power to this. Now, I think there is a good shot that we do at least come up and retest that previous high up at about 2134. Any kind of a positive catalyst might send us up there, but you have to wonder, what on earth is going to be a positive catalyst? Really, is that going to be it? The Fed getting out of the way is a positive catalyst? A true positive catalyst would be U.S. companies digging themselves out of this current earnings recession that they're in. Meanwhile, we have plenty of negative catalysts coming on out there. Again, who's going to be the next shoe to drop that's within the European Union? Are we going to have any troubles here domestically as we get into the election cycle in the next few months here? Don't know. There's a lot of risk to the downside, as always, with markets near all-time highs. Now, I want to finish out today's video by talking about the bonds just for a minute. So these are the 20-year, right? So these are the 20-year Treasury bonds the TLT. This is an ETF, and it's one that a lot of people follow and watch, right? So what we can see right now is that we are approaching bubble status, and you can tell the bubble status basically by just the slope of the uptrend here, which has basically gone completely vertical to the upside, almost an infinite slope to the upside. So what I'm seeing is a lot of people saying, hey, it shouldn't be up there. Shouldn't be up there. Let's short it. Let's short it. Or they're trading bearish trades such as call credit spreads or just outright buying puts on the TLT. And so far I'm seeing these folks run over like a freight train. So it's not a whole lot of fun to see something like this happen. What I would propose is that we take a little bit more objective view on something like this. So one of the things that I talk about all the time in the trading room is I've got some very simple rules when it comes to trading. Price action. First of all, the larger time frames will dominate the price action. We tend to focus on what's happening at the daily chart over here, but losing perspective of what's happening at the monthly and the weekly charts, it's almost like ignoring your parents, right? And just paying attention to the child in the back seat. Well, that's not going to be very sustainable. So that's rule number one, is that larger time frames will dominate the trend. And right now, the larger time frames are in charge of this and are completely dominating this uptrend with this parabolic move to the upside. But if we do start to see a move to either a consolidation or an outright downtrend, because we know that these exponential moves like this always have a very rough time in the backside. You can point to any chart that you want to, whether it's, let's go over here and look at something like silver back in 2010, 2011, okay? Or we can look at crude oil back here in 2008, right? So all of these, anytime we see a market going completely vertical, it's always going to have a very difficult time on the backside of this. So what we can do is, instead of getting caught up in the emotion of one of these moves, and never ever just try to jump on board one of these things, right? But at the same time, I think also just shorting this in the face of strength is asking for trouble, unless you've got, unlimited capital to be able to burn on something like that. So what we can't do instead is my second rule, which is that reversals start from the inside out. So again, this is something I share with the folks in the chat room all the time, is reversals start from the inside out. They start from the very smallest time frames. So what you'll see is the daily chart will start this first, or actually even an intraday chart will start before the daily chart. But you'll see this pattern of higher highs and higher lows all of a sudden broken with a lower high and then a subsequent lower low. And what this will do is start to propagate over to the weekly chart by pulling in just a pullback. Okay, so this is not yet a reversal, but then on the next subsequent rally back up, the weekly chart will start to copy this in a fractal manner. It'll pull up to a lower high and then a lower low as well too. Uh-oh, what do we have here? We now have the start of a monthly pullback, not a downtrend, but just a pullback. And then we know that this is something serious is about to happen if the monthly chart pulls into a lower high and subsequently lower low and pulls into a downtrend. Then stuff gets really ugly. Now's the time when you can really put the hammer on the short positions. This could take months to set up. Can we play within these swings with daily chart swings or weekly chart swings? Yes. But the big money is going to be made after the monthly chart sets up a lower high and then completely falls to pieces, right? So bears, as a rule, get on board way too soon, way too soon. They're not patient enough to wait for that lower high to set up, because they are sick and tired of getting bent over all the way up here and can't wait to take revenge out on this trade to the downside. But unfortunately, it's a lot of times these moves can go much, much higher than you would ever believe before they finally start to crack. And again, they will always start from the smallest time frames and then propagate higher like this. So be patient, and you can get a much cleaner entry that risks a lot less if you're just patient to wait for this erosion of the trend to start from the smaller time frames. So that is it for today's report. Thanks for listening, folks. Have a great weekend, and we'll see you next week.